Trump is threatening tariffs because he wants to take over Greenland, which we'll discuss if that's actually a good idea, if the United States should do this, why they would want to do this, etc. But based on the market's reaction to the second, third, fourth order implications, that can give us a lot of insights into whether or not something like this would actually play out. So, level one, Trump wants to take over Greenland. Why? Well, if you watch Thursday's show, which, to repeat myself, the main idea that we discussed there, and this is the main idea of the Trump administration, is there's $38 trillion in debt. How can we get that down? Well, they've tried a bunch of different things, but ultimately what they're resting on is currency debasement and growing the economy faster than the debt. If they can increase the production of goods and services and grow GDP faster than the interest on the debt compounds the debt, and further deficit spending also compounds the debt. If they can grow the economy faster than the debt, it's basically not problem solved, but problem relieved. And so Greenland is filled with a boatload of natural resources. Lots of oil, lots of what they call precious earth materials, right? It's things you use in semiconductors to build chips, data centers, all this stuff. It's a safe haven or you know, a global haven of natural resources. So from that level, it makes perfect sense why the United States would want to take over this land. In addition, we already have a Space Force base there. And Greenland, while it's somewhat of a sovereign state, is actually under the rule of Denmark. Now, Greenland operates domestically. They, write their own laws, whatever. But from a geopolitical kind of nation state level, they're under Denmark's rule. Denmark is in charge of all their military defense, that sort of thing. And so they're kind of this quasi sovereign, quasi, you know, p- property of Denmark type entity. So it's not like, if the United States went and conquered a different country like Canada or Mexico or whatever, where they're their own sovereign people, their own sovereign nation state. Greenland is a little bit different in that regard. And so they have all of these natural resources. And as the United States tries to position itself to be a faster growing economy, the main method through which that's going to happen is, of course, artificial intelligence, right? If you can get a bunch of omnipotent, all knowing, all powerful robots that can work in factories and can do all the white collar work and can just produce mass amounts of goods and services at basically little to no marginal cost, that's going to actually allow the economy to grow faster than the debt, which the debt is growing quite rapidly, I may add. About 2 years ago, it was just around 30 trillion. Now it's almost 40 trillion. In 2 years, we've added $10 trillion. I don't know how long it took to get to the first $10 trillion, but I can imagine it was probably over 100 years versus now in just 2 years, we've added 10 trillion. So the debt's growing fast, but can we grow the economy faster? That's the primary objective with taking over Greenland and accessing all of those natural resources. We didn't mention it last week on Thursday, but this is also the idea with Venezuela, right? The United States went and ousted their president, and basically it's at the present moment seems to be US territory. There's a lot of oil there that can stimulate the economy, that can get prices down, allow the economy to grow, et cetera, et cetera. So strategically, when we analyze the scope of events and policy from the Trump administration, right? You had Doge, you had the big beautiful bill, you had the tariffs last year. You've had all these things that are designed to address the debt problem. Taking over Greenland perfectly fits in with that idea, right? We want all these natural resources to stimulate our economy. Let's take it over. Now, the market reaction has been very telling. So first, markets were obviously closed yesterday on Monday. So Bitcoin is the canary in the coal mine, right? It is the only 24/7 globally traded asset with billions of dollars in daily trading volume and liquidity. So it always reacts first to news events. Because the markets can be closed, Bitcoin is always open. And so Bitcoin initially dropped from about 95K to 93K. So that gave us a little bit of inside baseball into how traditional markets would respond when they opened this morning. And the response has been alarming if you are the Trump administration. So The equity market is down as expected, but additionally, the bond market is down. And the long end of the bond curve, and this is very important, this is going to be kind of the base of this discussion and really the signal that we can derive from all of this chaos. So the bond market continues to fall. The bond market, which is the quote unquote risk free safe haven asset that is the bedrock of our current economy, is US debt, US Treasury bonds. The 10-year Treasury bond, you loan money to the government for 10 years, that rate that they pay you, that is the risk-free rate, right? They can always pay you back because they can always print money to do so. And so most of the financial calculations in the world are derived from the 10-year rate, right? Am I going to invest in this equity or this business or this asset versus lending money to the government and getting this guaranteed rate? So the treasury bond market is, of course, the most important market to watch in the world. And I'm going to pull up the screen share here and you can see for yourself exactly how the treasury bond market responded. It hasn't been good. So the bond yield is up. Oh, it peaked over 4.3%, went up basically 20 basis points overnight on the back of this tariff news. And interestingly enough, this is basically what happened last year. So I'm going to zoom out the chart here. Again, this is the 10-year bond rate. I'll flip really quickly to the 30-year bond. Same thing, right? It peaked almost over 5%. And if we zoom out to the 1-year view, this is what happened last year. So like I mentioned on Thursday's show, the first order of business for this administration, explicitly from Trump and from Secretary of the Treasury Scott Bessent, was to get the 10-year rate down. They can borrow, if the government can borrow at a lower interest rate, that's obviously going to help the debt problem. Moreover, it's going to allow for more economic stimulation with the 10-year rate being down, right? The opportunity cost to buy government bonds is lower. So, therefore, investors, entrepreneurs, builders are going to invest in other opportunities. Additionally, mortgage rates would therefore come down, more activity in the housing market, etc. So, they want the 10-year rate down. And in theory, and I think this is what they were going for last year, and perhaps even to some degree right now, if they can cause uncertainty in the markets, in theory, that would cause a bid on the 10-year, which would get the 10-year interest rate down, right? If there's uncertainty in the markets and the economy and people don't know what's going on, they're going to say, hey, I don't know what's going on here. So I'm just going to buy this safe asset. I'm going to buy government bonds. I'm going to take the guaranteed 3, 4, 5% yield, whatever it is. And then I don't have to worry. I don't have to evaluate companies, look at their PE ratio, evaluate their cash flow and their earnings during a very turbulent and uncertain time. So they'll say, hey, I'll just buy this safe, the quote unquote safe asset. But what we saw in 2025 when the Trump administration very purposefully caused uncertainty within the markets, right? We had tariffs, they're on, they're off, they're on, they're off. They're 100%, they're 10%, right? Just completely jerking the economy around. Nobody knew what was going on. And so by deliberately creating uncertainty, the idea was the 10-year rate would come down. But the total opposite happened. People, investors, they actually left 10-year bonds and went to a more certain asset, which is gold. Now, as a Bitcoiner, I would argue that Bitcoin is the most certain asset, and it one day in the future will be the thing that responds positively during times of uncertainty. Right now, that's not how it trades. Right now, it trades as the thing that responds negatively during uncertainty. So during this tariff tantrum that they call it, Bitcoin dropped. Then we catalyzed this bull market in gold that went throughout pretty much all of 2025. And ironically, and this wasn't the administration's intent, I don't believe, but the 10-year bond yield increased. 10-year bonds, 30-year bonds, 20-year bonds, they got sold off. And so when we look at the chart, the initial response going into the tariffs was actually the 10-year rate was starting to come down, right? This is January 15th. Trump, I believe, took office on January 20th, which coincidentally enough is actually 1 year ago today, to the day. The 10-year rate was starting to go down, and they got it as low as under 4%, right? But then it just rocketed back up. And now it's still been kind of just treading water in this 4% range. So the primary mission from the get-go to get the 10-year rate down has not been working. And what we're seeing today with the bond market reacting again to news about potential tariffs is not good. It's not a good sign for the 10-year rate. It's not a good sign for the administration and their goal of getting that 10-year rate down. Now, are tariffs actually going to happen on, they say, 8 different countries in the European Union? Maybe, maybe not, right? That's kind of the point. The point is uncertainty. Create uncertainty in the market. It's not working. Additionally, tariffs, as we saw last year, they're really just a negotiating tactic. By being very extreme and saying we're going to do tariffs on all of these countries if they don't give us our demands on Greenland, it's going to make those countries more likely to capitulate to some of the president's demands. This is The Art of the Deal. I've never read the book, to be transparent, but the summary I've gathered is that you kind of start with these hyperbolic, very extreme negotiating points. Now, to me, it seems this would only work if you're in a position of power, right? If you are the United States president, you are in charge of the strongest military in the world. I wouldn't recommend trying this tactic if you're applying for an entry level job, right? Saying, hey, I only want, you got to give me 250K a year, fully remote, give me a Bentley on my sign in. I don't think that's going to work very well in that negotiation. But when you're the president or when you're Donald Trump, business mogul, real estate mogul, and you do negotiate from a position of power, it makes sense to really over request on your demands when negotiating and then kind of see what you can get from there. And that's clearly what the tariffs are, right? He's saying, hey, we're going to tariff all of these countries at very high rates if you don't give us what we want, which is Greenland. Now, he's not being totally authentic in that, right? Because he's not actually going to tariff all of these countries at extremely high rates. That would likely cause a bunch of chaos in the economy and markets, and I don't think it would go over well. But by threatening to do that, he can be more likely to get what he wants, which is Greenland. So the high level and the summary of all of this is that the 10-year rate is not responding well. And the more the 10-year rate continues to increase, the more likely it is that the president has to kind of either rein in the rhetoric or outright say, hey, you know, come to a deal, right? Strike a deal on Greenland. The pressure is on when the bond market is falling. Again, I'll say that again. The pressure is on when the bond market is falling. The bond market not reacting very well to this news. Moreover, the clock is already ticking, right? Because in 2025, when we had the tariff tantrum, which I wish there was a better name for that because it sounds more degrading, as if you're critiquing the strategy, which from a first principles level, I actually kind of like tariffs. I think it's going to be good for the American people, the American job market. I think it's good that we should be producing more physical assets within America. We shouldn't be outsourcing the production of physical goods and services to the rest of the world from a strategic standpoint. So I don't like the term tariff tantrum because of the negative connotation, but that's just what it's called, right? We had this tariff tantrum last year, and the bond market didn't do well. The equity market didn't do well. But 2025 was not a midterm year. 2026 is. And so I highly doubt the president is going to want the markets in hot water, in turmoil, going into the midterms later this year. So I don't think this instance of tariffs will have quite the negative impact on markets as 2025. We'll see. We'll see how long he holds the line on this. I'm not confident that he will hold on to it for a very long time. So I think this will be ultimately kind of a bump in the road, slight headwind on a short-term basis, but I think throughout the rest of this year we're going to see risk assets do well, specifically Bitcoin, specifically US equities. So with that said, let me switch back to the widescreen view and we'll get into our next topic of the day, which additionally, I want to make one more point on this. Let me go back to the screen share. Here's a chart, and I want to give a shout out to my friend John Har, John _@ Swan on X, because he brought this to my attention. And this chart here, what this shows us is the Fed's balance sheet based on duration of the treasury bond. And here specifically, we're looking at only bonds greater than 10 years. So 10-year treasury bonds, 20-year treasury bonds, and 30-year treasury bonds. And this story hasn't been talked about enough because throughout all of the past 3 years, when the Federal Reserve was allegedly in quantitative tightening, right, their balance sheet, it was technically shrinking. The amount of long-term treasuries they were holding actually increased. That's what this chart is showing us here. So since 2020, obviously you had a massive surge during the tsunami of QE during the coronavirus lockdowns. But even during this period of quote unquote QT, where the Fed's balance sheet was shrinking, the amount of long term treasuries they were holding was actually increasing. So over the past 3 years, while the Fed's balance sheet was shrinking, they've been acquiring more and more long term treasuries. What does this mean? Well, it means, for one, the bond market is in even more of a fragile state than we might have initially suspected, right? So the Federal Reserve being this kind of buyer of last resort for treasury bonds, providing this passive support to the long end of the curve over the past few years. Imagine where the 10-year rate would be if they weren't doing that. Now imagine where it might be headed in the future as they really truthfully engage in QE. Now, um, rather, over the past few years, right? Here's what was going on. You had the Treasury market issuing a bunch of short-term paper, and then you had the Fed letting that short-term paper roll off their balance sheet. So we're talking, 2-year bonds, 1-year bonds, 6 month, 3 months, right? Because the Treasury did not want to refinance for 10 years, 20 years, 30 years at the higher rates. So they're saying, hey, all of the money we're going to borrow to finance the government and to fund our operations, we're going to do so with the short end of the curve, with very short maturity debt. Meanwhile, that debt was also the form of debt that the Fed was allowing to roll off their balance sheet. Because if you look at their balance sheet as a whole in the aggregate, it was technically shrinking. But because we looked at the long end of the curve and their holdings of 10, 20, 30-year treasuries was increasing, therefore we can reasonably deduct their holdings of the shorter term stuff was decreasing. And this explains why we got an inverted yield curve in 2022. Historically, an inverted yield curve, which means the interest rate on short term debt is higher than long term debt, historically, this signals a recession. And on a elementary level, right, this wouldn't make sense. Why would you get 4% lending to the government for 2 years and 3% lending to them for 10 years, right? Because in theory, the risk is higher the longer the terms of the loan. So historically, this has signaled a recession is coming, right? Because investors, they want to pile into the quote unquote risk-free asset. But what happened is we never got that recession. The yield curve inverted, but we never got the recession. And this really explains why. Because the Federal Reserve was allowing the short-term paper to roll off their balance sheet, at the same time, the Treasury was issuing much more heavily on the short end of the curve. All of that resulted in an imbalance in supply and demand on the short end specifically, while the long end was being supported through one, less issuance of long end debt from the Treasury, as well as continued accumulation of long end debt from the Fed. So what we're seeing is these two different arms of the economy, of the banking system, of the fiat system, however you want to describe it, these two separate arms, the Treasury and the Fed, kind of working in tandem to support the bond market. Now imagine again, let's pretend that support doesn't exist. The 10-year rate would be much higher. But I think we're going to see this support working in tandem together, even more so to support the long end of the curve, because we're not seeing the market organically bid the 10-year rate down, even during times of uncertainty. And so what does this mean? Well, ultimately it points to more QE, right? The Fed is going to have to support the long end of the curve even more, which is more liquidity in the system, which is bullish for Bitcoin and bullish for equities, for gold, for pretty much everything. Pretty much any hard asset is going to perform well during QE, which that's where the puck is headed. The puck is headed towards more quantitative easing in 2026, and likely 2027 and throughout the rest of President Trump's term. Again, we discussed pretty in depth on Thursday about Jerome Powell, the position he's in, and the expected dovish Fed chair to come later this year. I think what we're seeing in the bond market today specifically kind of points to all of that. So that's what's going on today. That's the main idea behind Greenland taking over that, the tariff, how the market is responding to all of this. And so from there, we're going to pivot to a bit of a different topic, which I'm super excited to talk about. And let me get back to the screen share because we're going to watch a